All right, we are rolling. Kyle, great to have you, man.
Always a pleasure to be here.
Yeah. No, this is a long time coming. We had a chance to chat a little while ago on your podcast, and Aaron and I are really excited to have you. It's cool to deal with somebody in the industry who also understands maybe the pains and struggles of what we also go through.
Absolutely. I love connecting with the other pros and the people who are doing big things and helping big projects. So yeah, happy to be here.
I like the honesty too. I think every time we've chit-chatted either in person or over the phone, there's definitely like 30 minutes of just honest, like brutal, like opinions of what's going on in the space and clients and stuff like that. And, it's just good to be able to chat with people and kind of vent out the industry, just get the stuff out of the system.
100%.
Yeah, so I mean, you specialize in something that is very unique to maybe like niche, maybe investing or like kind of like the realms of mortgages that most people don't touch on, which is like true hard money, like structuring capital in a way in which, most brokers either dream about or never get the opportunity to really think about. Tell us a little bit about that. Like, you obviously have a fund, you structure this stuff. How does this work?
Yeah. So I started off as a traditional mortgage broker, dealing in the traditional elements of getting a bank mortgage, using an alternative lender, that type of thing. I was introduced to private money about 6 years ago, kind of for my own personal portfolio, and that lender told me, he said, "Start telling people you have private money," and I was like, "Do I?" He's like, "Yeah, you do." So I did. I honestly, I didn't know any better. I started saying, "Hey, I have access to private money. Send me your deals." So started getting all sorts of different projects. And the one thing that we specialize in private money is we do not lend money to consumers. So we're not going to lend money to a family if they're struggling to pay their bills. And you can make a lot of money as a private lender doing that. The downside to it, though, is if the deal goes sideways, you got to kick a family out of their home.
Yeah, exit.
And I don't love that. Yeah. So we only lend money to investors. So we lend money to people who are buying, acquiring, flipping, construction, whatever that may be. And the key is around exit strategy and speed. Private money is in the long term is a very two-sided double-edged sword. If you're in it for too long, it's going to erode your project and ultimately get you into big trouble. So the one thing that we're, especially in today's environment, we're really looking for projects that are, looking for gasoline on the fire. Yeah. They're ready to go. They need to acquire it quickly, and they're ready to go. They're approved. They need funds to finish. Whatever it is, just that they can quickly get in and quickly get out. Because we're seeing well-intentioned people who had a good plan, and the plan didn't go as such, and now their margins are being squeezed dramatically to the point of concern in some scenarios. So,
and that's, exit is the biggest, obviously, thing when you're taking a look at private money. But I like that you obviously come from the mortgage background because you're able to underwrite the deals yourself. So, I know we send you some private files as well too. So, on situations like that, you get underwriting from both sides. We're underwriting, exit, takeout, and upfront underwriting, and then you guys are also taking a look at it on your end, which is good because you're getting two set of eyes on it. So you're getting two points of verification that the project makes sense, the exit seems viable. Whereas, and nothing against some of the lawyers, but sometimes if you're going direct to a lawyer who can be great solutions, they're not necessarily doing the underwriting, or maybe they don't understand the underwriting or whatever it is. Maybe they have some people in-house, and nothing against those guys. But when you're working with like mortgage brokers that are doing origination on the private stuff, you're getting the two set of eyes on. And again, like it's good for the client. As much as clients may hate the due diligence and they, hey, let's just get the money flowing here. But, we're looking out for the client's best interest. And when you have a lender that's also doing that, and you're also doing it for your own guys too. So, if you're lending on a deal, you're protecting the client, but you're also protecting your investors, which is, huge because again, if you're putting that risk out with the private money, it ensures that safe exit's going to be there.
And what you're saying is what I tell people all the time. If you get told no for private money on your deal by everybody, that might be a good thing. Private lenders want to lend their money. Absolutely. They want to put it out. If you're being told no and nobody will give you funding, there's a concern there, and you might actually be taking on a lot more risk or getting yourself in trouble by doing the deal. So if everyone says no, you kind of got to look in the mirror a little bit and say, is my project viable? Does this make sense? is this a good thing that I dodged a bullet and didn't get into this? So when you're working, like you said, you can go to a lot of lawyers and they'll say, yeah, I'll lend you the money. Well, if no one's found a way out of that for you, you could get yourself in big trouble.
What's the Facebook like graveyard? I kind of like started deeming it like if I start seeing, clients that I've talked to, or not even potential clients, but just people that have reached out, because most of our clients are thankfully pretty safe, but people that I've had maybe a conversation with, chit chat or whatever, they've reached out, and I start seeing that deal floating around, or you get the, hey, I'm looking for, whatever it is. And, I want 20 million, but I don't want a broker to be involved. I just want a direct private lender. And I'm like, if this is where you're doing this in Facebook, like the danger of this is huge. Like brokers are there for a reason. I mean, we're here to help. We're here to make sure that your deal is going to go smoothly, that there is an exit solution. Like nothing like getting stuck in like, $2, $4, $6, $8, $10 million in debt with no exit because you just wanted minimal fees and a quick closing on your deal. And then now you're kind of screwed, right? So
yeah.
It's the Facebook space. It's interesting, but the private lending world in general, like there's so many solutions there. And again, to your point, if private lenders don't want to do it, you got to start rethinking your project. You got to go back. You got to rejig the numbers. If it's a development project, start taking a look at the unit counts. If it's a conversion project, does this really make sense? Is it location? Is it dollar size? So many different things that could be a reason.
Well, we're starting to hear this a lot now because the document requests on private are getting heavier and heavier. And when somebody says, this is a big red flag to me, this is private, I shouldn't have to provide all this stuff. No.
No bueno.
No bueno. I like that. We're underwriting your exit. Do I need everything? Do I need every document here, like every lease you have on every non-subject property? No. But relating to the project, I need to make sure that you can get out of this thing. So that's what we're underwriting. And a lot of people need to wrap their heads around that it's private is quicker. It is genuinely easier, but this we don't have to provide documents thing is just not true because we're not just underwriting the close, we're underwriting the exit.
Well, I think it's important that's the difference between these people who can give you a private loan and, real estate capital advisory at the highest level. Like, as you said, you only deal with investors and you do that because there's a specific exit and these people are competent and they have capital and equity and a plan and they're executing on that. Like, when you're dealing with private money, I always kind of think of it as like a tool in my tool belt. Like, this is a piece of capital that you can use in a situation to be able to get you to the next situation. Like, this is not a long-term situation. This allows you to either move quickly, more efficiently, less red tape in regards to bureaucracy and process, but it's going to cost you a little bit. The competent people use it extremely well. The ones who are actively moving, who have equity, who have a plan, those are the ones who really use this as a tool to execute quickly. And I think just there's been a massive misunderstanding with that private capital side. I don't need any documents or I can just do this quickly. We've seen it just in the industry as a whole change when it comes to the regulation around it. Now mortgage agents need to be a level 2. You need to be a mortgage agent for a few years. You have to have people sign off on your stuff. If you haven't, the regulation around the whole space, I think, is overall good.
100%.
There's a lot of people who've been put in a lot of tough spots because they weren't advised properly on how to do this. And, circling back to not helping or providing capital to the retail, person for a home. I think that's obviously the most important thing. It's like helping people who have a defined exit. And where we're going with the economy right now, I fundamentally believe that private capital is going to continue to grow, and the need for that capital will grow because the opportunities that are out there, whether it's an underperforming multifamily building or a distressed property that's half done, those opportunities aren't going to get picked up by a bank. They're going to get picked up by an investor who has capital, who's looking to move quickly, but can't get financing from a bank.
100%. Yeah. Absolutely.
I think you should almost be concerned if your private lender is not asking you for anything. Like if this guy's just willing to give you money with no questions asked, like go back in there, probably start checking those clauses, because I guarantee you those fees are adding up pretty quickly. And there are sharky guys out there who will literally just, yeah, you want money? Sure. Yeah, you want 105%? Yeah, okay. But the stipulation is if you haven't paid me back within 30 days, like the property's gone, it's mine, and I own your kids, your wife, your cars. Would you not feel safer? I mean, I would feel safer if I was a borrower and my private lender is like, hey, look, I'm willing to give you the money, but let's make sure you're doing the right thing here, because now you know at least, hey, he's somewhat on my side here. He's trying to help me.
That's the type of guy that I call the first guy that doesn't ask any question. That's a loan to own guy. He's not trying to lend you money to help you in your project. He wants to take your property at a discount. He or she, I should say.
Yeah. 9 a.m. on the 32nd day, you're gonna have a notice on your door.
That's right. That's right. And I tell people all the time, I am in the ownership business in another business. My private lending practice, we're in the business of making our fee and collecting interest. We don't want your property. We want to help you get to your project. We will disclose our fees. We'll disclose our costs. You're going to know your interest payments. And we want you to get out of this so you come back to us for your next project. We don't want your project. And when people aren't asking questions, they might know more about your project than you do, and they're trying to actually scoop it from you because they think they can get a discount on it. So people do need to be careful about who they're borrowing money from.
Well, let's talk about that. I mean, obviously, where have we been at over the last few years? Interest rates skyrocketed, exits on development multifamily projects, underwritten at 3, now at 6. Equity positions are, larger equity positions are required than initially thought. Most people, or a lot of people that we saw over the last few years, either raise capital to get their equity position, and some people are in tough spots. As a private mortgage lender, what's happening right now in that market?
We're seeing challenges. I mean, we went a number of years without even a missed payment. So it was like years where we didn't even have a missed payment on our book, and it's a substantial book. Mm-hmm. We started to see the defaults happen about 15 months ago from where we are today is where it got significant. I still remember one group. It was like the first interest rate, then they had trouble. Like the first interest rate, and that was more of a representation of they had no plan. They were so optimistic. So. But we are starting to see the defaults now. We're into recovery on a lot of them. There are situations where we're looking at more of the foreclosure route than the power of sale. If we try to sell into a down market right now, we're at risk of loss.
Mm-hmm. Yeah.
So it's an important thing that a private lender remembers that there isn't a chance you have to take this property. Power of sale is ideal. If there's lots of equity, you can sell it, you get your money out, get your interest out, get your fees out, and get out of the deal. But if you're going to lend against a property, there is a chance you need to actually take over that property as ownership in the short term. So we have a couple of those projects right now that we are in the process of essentially taking over on the ownership level, maybe finishing some improvements. We're looking at two options, either selling in the coming months to hopefully into better conditions, and that's a bit speculative. Okay. We're also looking at a couple of those options, doing what's called what I call a debt to equity conversion. So if we're at a high loan to value on the project, we convert all of the debt on the project into equity, foreclose, so take ownership, and then go get like a 70-75% LTV mortgage back on it. So the original lenders get 70-75% of their money back.
Nice.
And then equity in the deal in the longer term.
Yeah.
The reality is if they try to fire sale that deal, they could end up with 80% of their money back now with no opportunity to recover. So that's some of the strategies that we're looking at right now. And for any private lender out there, understand that it's not necessarily what you want to do in the recovery process. It might be what you have to do to protect your principal.
Well, this is why you make 10%. Risk is a real thing. You can go buy a bond for 4.5%. This is risk. You want a double-digit return? Obviously you can cross T's, dot I's, but like risk is risk.
Especially in the market that we have come out of and we are entering forward. I mean, there's so many unknowns in the economy. Real estate is still, overall a little bit shaky. I mean, we have expectations of where it could go and the potential of it, but realistically, given tariff talk, given upcoming elections in Canada, you really don't know. And I mean, private lenders, good private lenders are always a really good indication of where the market is going, right? I mean, they're always the first one to move on the rates and fees and loan to values when you start hitting into a shaky piece of the economy. But they're also always the last ones to come back down as well too, right? I mean, if private lenders are pulling back within the market, 80% of these guys have made their money in real estate. They've been around for, 10, 20, 30 years, whether they are the lender themselves or the investor that's making the back end decisions of it. A lot of these guys have made their money in real estate. They know how to read the signs. They're familiar enough with the economy. They can see the trend. So you start to see lenders raising their rates, dropping their loan to values. Understand that we're entering into like a shaky period of real estate, and those rates aren't going to be the first ones to come back down either.
They're not nearly as, people, if we quote a private deal, like, oh, Bank of Canada just dropped the rate. Does that affect? No. No. Our highs and lows certainly didn't change the way the BOC did. It's really more supply and demand based and based on people's comfort levels. When people are scared, even if they have the money, they won't lend. There's less money available. Even if you have a good loan to value deal, if there's less capital available, you might get priced high because that's the capital that's available for your deal today. You need to close in 2 weeks. It's the market.
Yeah.
So
credit tightening, it's a great way to be able to keep like a barometer on like where things are at. Like credit tightening, you can feel it almost instantaneously. Like when something happens in the market and, obviously you're calling your private lender saying, hey, got this deal. It's a good deal. Gonna wait and see what this happens or that happens. Uncertainty is the killer for capital moving in a market.
It was amazing to me, it was probably maybe a year ago now when I started to hear from guys like yourselves, competitors, brokers, all people who are in the same space were calling me for capital. That was a sign of the credit tightening that was happening. Right? They're like the traditional lenders that we all were going to weren't available. We started going to each other. So that was a cool thing to see when I started getting the calls from, I say competitors loosely. I don't consider anyone that. There's lots of business for us all. But, people that are in the similar space we're calling each other saying, hey, what do you have available for this deal? Like it was interesting to see for sure.
It works too when you have like a circle of people or a group of people that, from a broker standpoint, like a common sense lending approach, right? Like when you go to a MIC and they're a more res-based MIC, like you're going to be just policy, right? Policy to death, right? Like, oh, our loaner values are down, our structuring is down. Like it's a stop, right? Like there's no negotiating with them because it's not up to your rep, right? But if you're going to hard money guys like yourself who understand res, understand commercial, understand construction, and we're able to bring you a deal and say, hey, look, we know the economy's shaky, but look, this one's a no-brainer because of this reason. Here's the underwriting. You guys can verify it as well too. We have the documents to support it. To be able to work with people on both sides of the coin that are able to look at a deal and understand it and see the potential in it, that's when you can still get the deals done. And I think that's why you start to see that switch. And, I'm sure the mix, I don't know if they feel it, but, from a lending standpoint, I think that is why you need to understand like who's in your circle and who can really underwrite a deal and is able to place a deal and get it done in shaky times.
Well, there's levels to it, and a lot of people don't understand. It's like people just see private money. Well, there's like institutional private money. There is like layers of different types of mix who have different risk appetite private money. There is, somebody who has a mutual fund trust private money. There is mom and dad private money. There's unicorn private money.
I've stopped calling mix private because I think it gives such a bad, you get clients, I mean, more so on the commercial side too, but you go to someone like Peak Hill and they're like, well, it's private. And I'm like, okay, guys, like, yeah, sure, they are a privatized, institution, but I mean, let's like be realistic here. Like they are a mega commercial type lender. They're basically a bank, but they're just lending at higher interest rates. So I think like, even from that standpoint, like you almost need to remove the word private from these.
I call them C.
Yeah.
I call them C.
Yeah,
I don't know.
Yeah.
I call that C, and that I call that institutionalized private, and then I call myself private.
Yeah.
Like I've got mom and dad's, Bob and Mary's. Like there's no credit facility. There's no anything like that. It's cash.
People don't know why you would do that. So if anyone's listening here and like you'd say, oh, well, why would Josh and Aaron go to a guy like Kyle versus go to like an institution? Flexibility, how fast you can do it. Policy. If the deal makes sense and you have collateral, you can be creative. Different locations. A lot of lenders don't have or have restrictions around like location. Very much common sense lending. Like, Aaron and I kind of cut our teeth with that back when we first got into it. But like, if you have other pieces of collateral and you can be creative, working with somebody who has that ability is so important.
Well, if we talk about like, we were talking offline, a little construction project in Kitchener, you submit it to, what I call like a C-type lender. They're going through policies and procedures, underwriting, everything. Sometimes you flip a deal like that to me and I say, I got a guy named Bob. He really likes this stuff. He's going to go drive by today. Mm-hmm. And Bob's got some questions and he wants to see the documents, but he's good to go. right? So that's kind of the difference there, right? Sometimes you need an institutionalized capital that's set up for CMHC, and sometimes you need Bob, who's just ready to go. He's got some questions, wants to see the details, but he's got the cash in a cashable GIC right now. He's the judge, the jury, the executioner. He doesn't have a credit board to answer to. He's good. He wants first position.
Yeah.
Send him your updated progress photos and invoices, and he'll send you the money you need.
The world needs Bob.
The world sometimes you need a
Absolutely.
Bob.
Well, I mean, it's the whole missing middle conversation, right? I mean, take out, call it like 5 to 10 million, because you can get some decent institutional private financing stuff for that. But the majority of the projects, anyways, if you're building 8 units in Kitchener, you're not going to be $5 million in loan size. You're going to be roughly 2 million, give or take a little bit. If you're doing even smaller stuff, conversion projects on pre-existing, where you just need $1 million,
The banks laugh at you.
it's almost even on the mixed side, even just to go to an institutional lender, it's hard to get $1 million on a reno conversion. And a lot of the guys don't even want to do the conversion loans because there's so many moving pieces. They're so risky, as the one deal we were talking about. But I mean, there's so much that can go wrong that the institutions, even at $1 million, they don't even want to lend on. And that's the perfect situation for guys like you. Small market, $1 million. That's kind of like your bread and butter type deals.
For anyone who wants to know why the institution, they're hard to pick up. So when you're lending private type capital, you're accounting for the worst case scenario. There could be a default. It's difficult for an institution to come into a conversion in Kitchener and finish it and take it over to protect their asset. For us, that's something that I personally do.
Yeah.
I have construction crews. I don't want to take over this project, but I'm happy to lend on these type of deals because if something happens and our borrower gets hit by a bus, family, whatever, and they need out, we're in a position where if we can't sell it to recover, we can send our own crews in and finish it. So, private lenders, I think you see this more and more, very location specific. And this is something in my younger years, I was a bit more of a cowboy. I was like, oh, we'll lend anywhere. Yeah. Well, when I saw defaults in North Bay, now my lending radius is about 3 hours from Kitchener. And the reason why that is the lending radius is because I can drive there and back in a day.
Gotcha.
And and like, is that a high level policy? No, it's, I have a wife and kids, and if I leave in the morning, I want to be home for dinner.
Yep. Well, I mean, you see that, and I mean, I know you see it, and who kind of we have in our lending market, but I mean, it's the same thing. Like, Barrie is kind of almost a cutoff because, like, Sudbury, well, I'm not driving 8 hours, so I got to fly out there, and then to take a private charter, get up there, fly there and back, take 2 days to look at it. You start losing equity on these deals that are in default, and when you start losing the equity, well, that too. But it's tougher to sell. But I mean, I get this question a lot on the mid-level space is, hey, I only need $2 million. Like, why is it so hard to find? Like, it's a low-risk loan. And, to your point, it's the misunderstanding of how a bank underwrites a construction loan, right? You go to a big institution, well, the big institution isn't going to spend their time to take on, a $2 million project. They're going to put it into technically some sort of receivership, and then you have to bring on or find somebody who's going to buy it and take over the project. And when you're in a, rural market, the margin of your equity in a deal that's gone south is just like evaporating. Versus if you're doing, a $30 million project in Toronto, well, that equity piece is safeguarded. You're not just deleting 5% of the equity every single day that this deal sits on the market. So, it kind of seems backwards, but the larger the loan, the less risky, quote unquote, less risky the deal is because there's more on that margin.
Here's this is almost more of an emotional thing that I've learned about about a power of sale and a default and taking over in the small markets. This is something that I never realized until I've dealt with it now. When you're in those smaller markets and you have a default, it's not only about the number of people that are available to buy. You become stigmatized in the small market. Everybody knows.
You're the guy who took that person's house.
And more trying to sell it. Everybody wants a deal. Everyone knows it's a power of sale. Mm-hmm. All the trades know about that the guys didn't get paid from the original person. So it becomes a massive stigmatization. When you have a default in Toronto, there's no little side story. There's no drama. There's no background. It's, hey, there's an asset for sale. There's 2 million people who live here. Mm-hmm. Who wants it? So I've learned in lending in these smaller markets, in the downside of things, it's not only number of people, but you get stigmatized in the market because it's a small town.
Yeah.
So that's I didn't have an analysis in my underwriting for that stigmatization, but it's something that I've learned in real life.
Yeah, I mean, like, and everyone has such unique parameters. I mean, you know, we talk about GTA as like a prime market, but there's some guys that don't even want to lend in the GTA. So I mean, like, it depends on who you go to and how they're underwriting. And again, like, I mean, that just comes down to who you work with. And you know, for us and for yourself on deals, you know, we know who to place things with, right? I mean, that's part of the thing of working with a broker is you save time going around. Like when we get a deal, we're like, okay, well, small town low loan size. Well, we can cut out 80% of the lenders that we know aren't going to be interested in this. Okay, larger loan, very specific type of niche deal. Okay, well, we know who deals in this type of asset class and this type of like loan product. Like there's so many reasons why to work with people who have, you know, the understanding. And do you still do brokering? I mean, random question, but yeah, you're still doing it, right? A little bit.
Yeah, you know, I finished number one in the country for my company last year.
Shameless plug.
Yeah, well,
flexing. Yeah.
So it's kind of the reality is though is it's funny. People ask me that all the time. Yeah, I still do a massive amount, but my team handles most of the day-to-day of the brokering. I'm mostly managing the private money now. So like personally, am I dealing with a res file? No. I have a team that does that. And I am candidly, I try not to make too many announcements, but I keep saying it in public, but I am becoming more of a lender. We are becoming more of a lender than a broker.
Well, and I mean, like,
Unlimited
being a
deals,
broker, I
not
mean, we
unlimited
understand
money.
where the, you know, I mean, like the progression is like, you know, realtors, okay, well, you're always gonna need the money. Well, okay, so mortgage agents are good, or being a broker is great. Well, as a mortgage agent, you always need to go to a lender. So, I mean, like, you're just moving more towards like the honeypot. I mean, like, you're just becoming the honeypot essentially, right? Like that's, and why not? I mean, as someone who's been around as long as you have and has the education and the experience and the knowledge and, you know, the systems and the processes, yeah, like the next common or the next, you know, easiest step for you is just to get to the point of being the source of the money, being able to do it all yourself.
Yeah, and it's in more business advice or coaching that I've been following is, you know, getting focused and can't be a master of everything. And we have a substantial amount of capital in private, and we're, even though it's not all in the fund between our syndications and between everything that we have, it's comparable to some fairly big size mix. So we're trying to get focused on that. We do want to move into the credit facility space. So we're doing a bunch of restructuring now to get it more formally under management. That gives opportunity to get credit facility. Credit facility ultimately lowers cost of capital. What you said earlier about levels is very true for me. Like we have 3 different funds that we can grab out of. We have syndications, and then we just have some high net worth Bobs. So, like, it's not when people say, you know, am I borrowing from the fund? Not necessarily. I'm going to underwrite the deal and then look at what buckets are available and see what not only fits my investor profile, but fits your deal.
Well, and that's a big thing for borrowers to understand for, you know, situations and setups like yours. It's not always, okay, Kyle's got private money. It's an understanding that a lot of this money is coming from investors, not just a bank line. So it's also going to be down to the investor, like who has money left. Like, you know, as we've seen in the last couple of years, pool started to dry up a little bit because there was more renewals than there was actual payouts. And in those situations, it comes down to, yeah, I have money, but I have money from investor A who, you know, doesn't like construction, but he loves reposition.
Yep.
Or, you know, I have money from investor B who doesn't want to do any of this stuff, but he just likes construction projects because in the event of a default, he can just take them over and he's got his own construction crew. So, you know, there has to be an understanding from the borrower standpoint too, that private money isn't just about having private money, but it's, you know, where's the pool of capital coming from? And again, you know, from us as like a broker, you know, there's also that understanding of where to place, but from the intricacies of how that money is put together can you know, dictate what kind of deals are going to get done.
100%. We had a deal close last week, and we told the guy it was a 50% loan to value. It was a layup deal, but the capital that was available was expensive. And we said if you can wait like 4 to 6 weeks, we have other payouts and lower cost capital that's coming. And he's like, I'm using the money for something else. I got a deadline. I'll take the higher rent stuff. So as long as he was aware of that, and that was the bucket that was available to meet his deadline, and that's private money. Like that, people are paying for speed and access. And we gave him the option. We said, if you can wait 4 to 6 weeks, there's a different bucket to grab out of. But if you need it closing by this date, this is the bucket that's available. So the investor is getting paid extremely well for a very safe mortgage. But this guy got what he needed, which was the money on the date and the time that he needed.
And people will pay it. You know, like I know a guy in the space, like multifamily space. He's a family fund. His return is like, he's like, I got to be at like 16, 18%. He goes, because we're already making 20% returns on our investments. He goes, so if I'm going to put the money out on private lending and take that away from our multifamily projects, he goes, why am I going to put it out at 10% and lose like 8 to 10% when I could just take that money and put it into a project where, yeah, it's going to take a little bit longer, but I'm going to make double the return on that. And he goes, people pay the 16%. He goes, so why am I going to, take away from that when people are already out there paying? So I think even from like a client standpoint or borrower standpoint, when you get told, hey, 10 and 2 or 9.5 and 2 or whatever it is, depending on who you're going with, even 12, second position, that's good price money. Like in that 9.5 to 12%, depending on the deal structure, location, loan size, all the parameters, like that is well priced in like private capital money. Like that's where it's at right now. So to see something like 16, yeah, it's higher, but still not that far outside of it when you take a look at all the costs in. And
if you're borrowing the money, the question you always need is what's your return?
Yeah.
For this guy, he was taking equity out of one of his properties, and he's in a different field. I want to be a little bit vague. He's in a different field that he had a short-term business opportunity that was extreme, like hundreds of % return for him. He was making a massive return on the short term on his other business entity. So the cost of the money at that point became very irrelevant to him. He just didn't care. So in all these examples, it's what's your rate of return?
Yeah.
If you're a consumer struggling to make ends meet and you're borrowing private money, that's a completely different conversation. Yeah. You need to be looking at whether you're in the right house. You need to be looking at if you have the right job.
Your budget.
Your budget. You're 100%. But if we're talking investors, it's pretty simple math.
The money's in the money.
The money's in the money. I love it.
Understanding it.
Well, there's a difference between like debt, call it like debt equity or like usable capital to get into a project versus just replacement of debt, which is you see a lot of like these consumer debt shops, which is exactly what you guys don't want to do. And I mean, we understand why, but when you're just replacing credit card debt or line of credit debt with other borrowed debt, you're just in that cycle of there's no exit here, right? Like, how do you get out of your, if we can't refinance you with a bank to pay out that debt to begin with, and you're looking at private seconds, where is the exit there? Unless it's one of these situations where, hey, the market really just flipped and rates are up, but we know in maybe 2 years we're going to be fine, which some people are in, but there's a lot of situations now where that's no longer a case. Like it's been too long and the affordability is too far gone that it's like, hey, you might just want to start look at selling at this point. And I mean, that can also be said too for a lot of these mid-level investors that aren't in the multifamily space, that just have a portfolio that's kind of bleeding. And I know I had this conversation with a client where, they were stuck in a lot of B-type variable loans, and they've kind of borrowed within their community to pay off some of their higher credit card debt. And now they're looking for another $500,000. It's like the affordability is just not there. Like it's no longer of how do we get private money. It's like you guys need to start selling your portfolio. Like
stop borrowing money.
Stop borrowing. It's gonna suck to feel like you're taking 3 steps backwards, but your long-term financial situation is not going to benefit by just recycling private debt, because like trying to outweight that market and hoping the affordability comes back down. It's not going to happen. I mean, everyone thought after COVID, okay, the rates will come back down. Well, hey, all of a sudden, Trump's talking about tariffs. Well, that's not, necessarily going to be a good thing for rates long term if that happens. So it's like there's so many unexpected things that can come up that playing the long term weight affordability game is just, it's so risky.
Yeah.
Agreed.
Yeah.
What you talked about on that, I'll just touch on the consumer side for a second. The people who are continually in that perpetual cycle. The main thing that we hear from those people when they do reach out is, well, we're like, have you considered selling and renting? Well, I want to own. You don't own your house.
Yeah.
You've got it. Like you're renting the money at such a high rate. If you just sold and got out of this, you can just rent a house and be a lot less stressed out. And it's the same thing on the investor side. Not necessarily they want to own versus rent, but like, how much are you continually paying in interest and fees? Like, cut your loss.
Well, even 2% annually on the cost of capital. No one's borrowing $50,000. Like, that cost, you can't outrun that. Like that's an insane amount of money just to be living Groundhog Day every single day, trying to pay the interest on this stuff. Like,
yeah, and this is what I've had to have some hard conversations with borrowers. The renewal fee is still due. Well, you're getting your payments. And we have a cost to our operation. I don't get that payment.
Yeah. ROI.
Oh yeah, like and if you pay me back on time, my investor would get paid again. We would get paid again. Like we'll give you a break on the renewal. We're not going to charge you the full fees, but there's costs. Well, I've been making the payment. Great. Terms of a contract, guys.
Yeah.
And this
It's still a business at the end of the day.
It's still a business, and we're getting a lot of people that think the fact that they're making their payment is they're not in trouble. They should get a ribbon. Like you do, and I do appreciate that, but you still have to honor the terms of your agreements. And there's a lot of folks that want to not do that. So.
I mean, you're aware of what you sign on day one, right? If you sign for 12 months and it's supposed to be matured and paid out on 12 months, and that comes in and, you're not in a position to exit. Well, I mean, you knew it was due. So again, to have the expectation of, well, hey, waive all the matured or all the renewal fees and hey, cut me a break because, Bank of Canada Prime is down now and we were at 10 and we should be at 9.5 now. And then that's, well, hey, you didn't pay your loan. So you're really not in a position to negotiate.
That's right.
You're the one that's technically, in breach of the contract. So
I like to give the same message I give to the borrowers, I like to give the same ones to the lenders. Don't spend your money on day 366 because a maturity date of a contract is not a guaranteed payback.
Yep.
It's your right to enforce. Mm-hmm. There's a lot of private lenders who don't understand that. They say, well, you should have my money back on 366, give it back.
Yep.
You're right. That was the term of the agreement, but it does not guarantee your payback. It's your right to enforce.
Don't they call that something, counting your chickens before they hatch or something like that?
It's like the start. It's start of the procedure, right? It's
the start of the procedure.
It's not loan repayment. It's procedure starter date.
Yeah, and
which could be, how long is the property sitting on market these days for?
3 to 9 months is
the
typical power of sale right now. We're seeing, even when people cooperate, like we've had some borrowers who have hit that stuff, and they've been really good with us. They're like, listen, don't accrue a bunch of legal fees. Serve the notice. I'll fully cooperate. I'll still cut the lawn. I'll still do things to help. Like they've been really, really good, but it takes time, and that's what the lenders need to understand. So
making your payments and being reasonable helps.
Yeah,
that's not the solution to a missed maturity date.
Yeah, of course.
So,
guys, 2025. We are in January. If we were to leave our guests with, a little bit tidbit of information, something that maybe they haven't heard or is going to help them this year, Kyle, if you were going to leave them with something, what is that going to be?
Get focused. Focus. And I'm hypocritical in saying this because I did the shiny object thing for so many years. Pick a lane, stay in it, and crush it. If you're the duplex conversion guy, you don't need to scale up to 6plexes. Crush your duplex conversions. If you're a flipper, you don't need apartment buildings. Flip.
Yep.
I'm not going to give specific advice of what strategy you should do in 2025 because I don't think anyone really knows. But my advice to people is pick a lane and stay in it. You can't save your way out of a bad situation, but you need to look at the bottom line. I use this as an example. My wife and I, we've done an audit of all these stupid subscriptions. Right? And like in the grand scheme of my business, this is not a lot of money, but it was insane. So, audit your financials, audit your budget, audit all your numbers, and spend time monitoring the bottom line. But if you're in a tight spot, you can't save your way out of it. It's top line revenue.
Yep. So
get focused on earning, and that would be the earned income. Borrowed money is not revenue.
Yeah.
When that money hits your bank account, you owe it back.
Yes.
It's a whole other conversation. But I mean, we've seen the return to work in the investment space, right? I mean, everyone's kind of getting back to work. Gone are the days of I made $200,000 on my first flip and I quit my job now, right? So I mean, people understand you need to have the income coming in. It's the only way to save your deal when it starts going south because even the mix need to verify your income, right? So you got to have the income there, personally.
Yeah. Absolutely, Kyle. Absolute pleasure, as always, every single time. It is such a breath of fresh air speaking to somebody who speaks the same language, who understands. Hopefully everybody who's listening today got a ton of value. We'll put your contact information down below as well if anybody wants to connect with you. But again, man, really appreciate coming on.
Thanks for having me, guys.
Yeah, my pleasure.